What's up? I'm Dan Fredenberg, and this is another Chance Encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are just kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. All right. Hopefully, you don't hate dubstep too much there, David. But thanks for joining, everybody. This is a Chance Encounter. I'm glad to see everybody. I'm joined today with David Anderson. How you doing today, David?
Doing well. Yeah. Love the intro.
Excellent, excellent. I always feel a little bit awkward. Like traditionally, for the first like 300 something episodes, I just edited in after the fact, and now we're on this different platform that has higher resolution, so it looks nicer. And so I do it live, and I feel super awkward when it's on there. But I got some great news for you today, David. I don't know if you're aware of this, but today we're actually joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a Chance Encounter where I interview commercial real estate players. That means buyers, sellers, deal sponsors, investors, all that kind of stuff. And you may ask yourself, why would you want to do that? And the answer is, if you've ever heard of a private off-market deal that you're not allowed to publicly discuss, they're sometimes called 506B syndications, then you should also know that the SEC requires that you have documentation of your prior substantive relationship, or else the SEC will get ants in their pants and shut down your business, and that's bad. But the benefit to you for watching is not only will you learn to more effectively communicate on the subject of commercial real estate deals, but you'll also understand how my guest fits into those. So before we get too far into real estate, though, David, do you want to introduce yourself a little bit?
Yeah, of course. Yeah. Again, awesome intro here. I love everything you're doing, and even seeing the music and all that stuff. That was cool. I haven't seen that on a podcast before live, so really cool. With that being said, my name is David Anderson. I am specialized in multifamily and RV parks. I also work with RaisingCapital.com. That's how you and I met. Was actually at the Raise Fest. Event out in Arizona with Hunter Thompson. So yeah, in short, whether I'm raising money myself or helping others, the whole goal is raise money, acquire real estate, play the game of Monopoly in real life.
I love it. I love it. And that brings us to our first segment. Before that, I got to say, but wait, check your eight. David, I don't know if you know how to do this or not, but maybe you can see through the camera and into the user's device, because down there might be this big, hideous subscribe button. And it's embarrassing, especially if you have youngsters walking by, they'll judge. And okay, it's a stupid joke, but whatever. Anyway, the five distinct motivations. Now, I've interviewed and spoken to literally hundreds and hundreds and hundreds of different investors and syndicators and deal sponsors and all that kind of fun stuff. And everybody has their own unique reason why they got into this business and why they continue to do it. But I found that they fit pretty neatly into these five different categories. And the relevance, though, is that these deals, they take months to close, they take years to go full
Oh yeah,
cycle. So it's
absolutely.
really important for real estate people to have some sort of idea of what's going to keep you working hard, and when the going gets tough, you're not going to throw in the towel. And even though everybody's motivation is unique, I find they fit very neatly into these five different categories. The first one of which is preservation of purchasing power. What's that? Well, some people, they're either W 2 work optional, or maybe they have a really serious W 2 and they're making far more than they earn. But when it comes to preservation of purchasing power, we're generally talking about people who have a portfolio of assets, and the way that they make ends meet is from the proceeds of ownership. And you might ask yourself, well, if the person is in that kind of financial situation, why aren't they sitting on a beach? Why are they going to make their next acquisition given the different risks and hassles that can be involved? And there's a few different circumstances that jump out as likely reasons why they're making their next acquisition. One is if inflation rears its ugly head, then clearly that's going to eat away from the purchasing power of your cash flow. So it's going to be time to make another acquisition. The other one, though, is if you're able to purchase at a steep discount. Now, of course, everybody should be trying to negotiate the steepest discount they can on their real estate. Lots of people say that's where you actually make your money, and that's perfectly fair. But these guys here in particular, they are not going to need to make a new transaction every 10 seconds like some of the people in this industry. So they're only going to pull the trigger if they can, if there's that distress or other reason for that kind of discount. Now, I'm not that far in my own journey in real estate. So what describes my motivation more accurately is I'm trading time directly for wealth. And that's because I got a background in technology. And if you have ever been a high wage or high salary earner, you probably noticed your tax bill is massive and you're paying more tax than people who are even making more than you. Me personally, I came to that conclusion after I was working for a real estate guy who was flipping 10 houses a month. He was doing 10 house transactions every month like clockwork for years before I started working for him. So it hit me, I should pivot and use my CRM and web skills and marketing and all this on-camera stuff to partner up with a deal sponsor and then get rewarded partially in salary, but more in the form of deployed capital, aka equity. So that's what I'm doing, and I get that that's abstract for some people, especially youngsters, because the youngsters, they tend to be focused on hustling like crazy right now so that they can fast track their retirement. But the more universal part of this motivation, as in like people who are in their 40s or 50s or whatever else, is you get that need to take back control of your schedule. And that's one of the promises that real estate, I think, really does keep, is that you can be more flexible with your schedule. But maybe that's what you want to do. You want to work fewer months per year, fewer weeks per month or something like that. And that's fantastic. The only mistake that you can make with this, though, is thinking that this is everybody's motivation. And I assure you, it's not. Some people, they are motivated by ambition. They want to buy their entire hometown. They want that generational wealth to make sure that their great-grandchildren never have to hold a day job. And that's why they're going to hustle into their 90s. But the one thing about this group is I know that it's vilified in some circles, but if you want somebody who's actually going to take care of the property, you need somebody with a substantial amount of hustle. And that's why these are great people to have on your GP team. Just like the last group, though, they're very similar to the second to last one in that they're going to keep on hustling into their 90s, but it's more because they found a sector of society, or maybe the environment, or maybe it's animals. Who knows what it is, but whatever it is, there's a big financial component to making it work and getting that kind of impact, and that's why they're making their acquisitions. So, David, of those 5 different motivations, what combination would you say describes you best?
Yeah, for me, it's always been the time freedom is super important, right?
Mm-hmm. Mm-hmm.
Time
Mm-hmm.
freedom, and of course, having the freedom with finances too, right? Having not only that security, but the ability to, travel or buy nice things, nice cars, whatever it is, just live life as best as you can while we're still here.
I love it. I love it. And of course, it's pretty easy when you're talking about motivation to sound, naive, overly optimistic, who knows what it is. And there are plenty of risks involved in every type of business. And real estate is one of the most mature of the bunch. So one of the things that jumped out to me. I don't know if you've ever been involved in a 506B deal before, but when you're involved in them, you should have a securities attorney involved, and that securities attorney is going to insist that everybody who's a GP or an LP, you should fill out this financial questionnaire that's super duper invasive, really, really uncomfortable questions like what's your net worth, that sort of thing. But when I was going through that questionnaire, one question seemed problematic to me just because none of the multiple choice answers, I felt they lacked utility. I couldn't actually use their answers. So I made my own one, which I think is vastly improved, and it's a fill in the blanks question. It is. There are many popular investment asset classes, but I think blank is too risky. So, David, it can be inside real estate, it could be outside real estate. What's too risky for you to invest in?
Yeah, for me it was car rentals because I actually experienced it. I had multiple cars, and long story short, it was profitable at first, but next thing you know, repairs needed to get done. Cars were getting totaled, accidents. It just got really, really messy. So looking back in hindsight, would I go back and do things differently? Sure. Did I think the juice was worth the squeeze? I don't think so. So
I
from
love
personal
it. I love
experience.
Yeah,
Yeah.
yeah, I love it. I love it, and it's especially interesting because of this next slide here, which is actually one that I skipped for the first few hundred chance encounters, and the reason is because I didn't want to throw too fast of a fastball for people who are more like front of house, the pretty face, the marketing person. Sometimes they're not really the type who can deep dive into a spreadsheet and get a lot of meaningful information out of it. So I didn't want to put people on the spot in the podcast and say, oh, well, which metrics do you like? But I realized that even if you are the front of house person, you're going to know a few different metrics that you're going to emphasize to investors and people in your circle. So I asked for a top three. And for anybody in the audience who's only listening and not watching, I read out the 14 that I have as examples here. It's not an exhaustive list, so you can feel free to go outside of them, but here they are. The first one is cash on cash. Second one is IRR, which is internal rate of return. Then there's cost per door. Then there's net operating income, or NOI. Then there's the going in cap rate, which is really telling you what kind of discount are you getting compared to similar properties in that area. Commercial properties, that's a published thing from many organizations, what the cap rate is for an area. Then there's the loan interest rate, which is especially important if you're going to be assuming a loan. Then there's the occupancy rate, which is the inverse of the vacancy rate. They're the same number, just inverse. Then there's the average income where the property is located. There's the amortization period of the loan. There's the difference between the market and the in-place rents. There's the population growth that gives you some baked in demand, aka appreciation for your rents. Then there's the sponsor record, which is how many deals have already gone full cycle and how many deals are on the go right now. There's the waterfall split or exit strategy, which is what happens to your investment after your capital has been returned. Then I have DSCR, which is debt service coverage ratio. It's a way of finding out the amount of leverage because it means how much of the revenue from rents is going out the door right out the bat, just in the form of paying for the loan. So, David, maybe you can give like a top three or something like that. Which numbers do you focus on so people in the audience know how to communicate more effectively with you?
Yeah, of course. Best numbers to always focus on is what's important to the investor. Always, hands down, right? And I'm always going to do that in discovery. Now, if it was my choice, net operating income, cap rate, and occupancy rates always seem to be a popular one, right?
Mm-hmm.
Occupancy telling, what is this property actually be doing? Like how many people, if it's 95% occupancy, that's a good sign, right? It means it's filled up, right? And of course, not net operating income, cap rate, those are going to affect the actual value of the property. So long-term buy and hold, that's going to be a very important metric as well.
Mm-hmm.
It's hard to pick,
Absolutely.
right? It's hard to pick. They're all important, but
Definitely, and I gotta tell you, I love your answer just because, like, I always like to go for the low hanging fruit as well. I don't want to turn around to somebody who's in mobile home parks and be like, oh well, what about this self storage deal? It's just why don't
yeah,
you just ask what people want, right?
exactly.
Exactly. I'm eating that answer up like a delicious subscribe sandwich. Is that intense enough for you? It's pretty wild. But anyway, that's my little reminder that it's time to bring out the Dan Does Deals Commercial Core Competency Cube with the 6 different roles in a commercial real estate deal. And the whole purpose of the cube is to be the linchpin in you learning how to more effectively communicate on the subject of commercial real estate deals because you understand the roles. And if you end up watching this and finding out how my guest fits into these deals and thinking, you know what, I need to get me one of those. Well, the good news is it's absolutely free. You can go to dandoesdeals.com and then there's a great big button you can click on that sends you straight to the PDF. You can download it, print it out, practice on yourself, your friends, your family, all that kind of fun stuff. And the reason why I want you to do it is because I do think that your career and future in commercial real estate and even just investing, it's going to hinge on your ability to effectively communicate. And yes, you heard me right. I committed the cardinal sin of marketing. I gave access to my freebie without asking for an email address or any contact information at all. That's a terrible thing to do from a marketing perspective, but if you hit dandoesdeals.com, you can get it. So let's get started. First person I want to talk about is repositioners. Repositioners are the most visible people in a commercial real estate deal. So on social media and whatnot, you're going to see these people more than the other roles. And their role to reposition is to figure out how can they make a property make more money than it is right now. So they have to do a lot of paperwork, in other words, underwriting, and they also have to look at a whole bunch of properties to find out which one has most of the potential. So how do these repositioners find that upside? Well, they got a few tools in their tool belt, and I'm going to go through most of them. The first one, which is the most peculiar of the bunch, is all repositioners have to have a vast network of financiers and be involved in financier relations. What's that all about? Financiers are not on the GP team, so all that they're dealing with is the owners of the property, the paperwork, and the money. So that is their role. They're primarily lenders. Now, the reason why repositioners have to have these vast networks of financiers is because if they can secure a more advantageous loan, aka cheaper money, that's going to make the property more profitable right off the bat. So that's why they need to know lots and lots of financiers. But the second place a repositioner is generally going to look is in operations to stop those Benjamins from going down the toilets. Now, of course, there's more to operations than just collecting rent, mowing lawns, and different maintenance and things like that. And me personally, as it says in this ridiculous little header thing, I'm from the internet. So my contribution to GP teams for the operations piece of the puzzle, it's the digital assets and the marketing aspect. Now, of course, I tend to focus on bigger properties if I'm going to be a GP, and then that way that makes sense for a guy like me, but they're probably outsourcing property management to a third party, so what's the role? Well, if you understand that vacancy is the real enemy, it really is the deal killers, then you really should have somebody on your GP team with some serious marketing chops, because then you can hop in and get those units filled, and that's one way that I've thrown my hat in the ring in the past. But of course, there's only so much you can do with operations, so the next thing the repositioner is going to do is get a contractor team involved to upgrade the property. That way, the future residents would be happy to pay more in rent than the previous ones because it's a nicer place. But if only things were that simple, you can go ahead and gold plate the toilets, but you're probably going to lose a bunch of money doing it. So somebody has to keep an eye on those contractors to make sure they're not using subpar materials and they're not dragging their heels. And it's also true of the operations. And if you're like me and from the internet, you're going to need a local. You need boots on the ground, somebody who can be there in an hour or two, because that's not going to be me. I'd still be stuck in an airport in an hour or two. So this local boots on the ground role is absolutely vital. Now, that is 5 out of 6 sides, and to explain the 6th side, I'm going to do a little bit of a hypothetical with you. Many people who are engineers or doctors or attorneys, in tech and things like that, we frequently end up buying our first single-family house rental or something like that, and we get the idea, oh, okay, I know how this works. I put down the deposit, and then I borrow the rest, easy peasy. So maybe in this hypothetical, you get the idea, hey, I could turn around to my colleagues, we can pool in $100K each, and I bet you we could take over that 350 unit apartment complex that's just down the street. So you make it happen, you turn around to the financiers and say, hey, I want to buy that 350 unit apartment complex that's tens of millions of dollars. You don't have, I don't know, tens of millions of dollars you want to lend us, say, do you? Well, there's a little bit of a problem with this hypothetical, and if you're in a mentorship program or you have a guru or something like that, I highly encourage you to listen very carefully to this next part, because I find they tend to gloss over it a fair bit. The financier is going to ask you, who's your sponsor? Who's your KP? What's that all about? If you want to be eligible for a commercial loan, the lenders have to protect their depositors' capital. So they need some sort of indication that you're not just going to make the acquisition and run the place into the ground, because they're very capable of doing that themselves. They don't want that. So they're going to insist that somebody in the fold already owns a similar asset, or else your team is not going to be eligible for the commercial loan. On top of that, you need a certain amount of liquidity to prove that you can actually run the business. And on top of that, the GP team has to have a balance sheet, aka collateral, worth at least the amount of the loan. But if you got all those pieces, you got yourself a commercial real estate deal. So, David, as far as you're concerned, I know that like Raise Masters, Hunter Thompson, he tends to promote a fund-based model where you're really focusing on the financier relations. But I
Of
don't want to
course.
put words on your mouth. Where do you fit in the big scheme of things?
Yeah, when you say where do I fit in, like what my role is, or
Yeah, your role. I get that, everybody's on a team and then, you'll have like a deal sponsor, you'll have like these different things, even
yeah,
if you're.
as far as our members, we have over 600 people that we've helped raise capital for. So everyone's going to be different, right? As far as me personally, I'm more on the capital raising side. I guess you consider that the
Yeah,
putting the
financier
financiers
relations.
together. Exactly. So I would be on the capital raising side. The first two RV parks that I was part of that we acquired, it was about a $7 million raise for both of them total. I was just raising the equity on that side. I already had the loan sponsor with a great relationship with the banks and all that. So we actually had multiple offers when it came to the debt side. It just, as you know, it's coming up with equity, finding
Mhm.
people that you build relationships that you trust with. I'm on a new deal right now. It's a multifamily 136 unit out in St. Pete, Florida. And that's a
Mhm.
$20 million raise. We're about 17 million we've raised so far, 10.5 of that in debt. The rest
Mhm.
6.5 in equity. We got about 3 million left to go on the equity side, right? So 3
Mhm.
million short. So I'm an asset manager, general
Mhm.
partner, but ideally, where I'm helping out with is the marketing side, the investor relations side, building those relationships and continuing that. So raising money
All right.
for it.
All right, awesome. And
Yeah.
just for my editing purposes, that's a 506c for accredited investors. That one you
For the
just
St.
mentioned.
Pete deal is a 506c. Yes.
Excellent, good. So I don't have to edit it out. Fantastic. The law is tricky sometimes, but let's get on to my next
Of
favorite
course.
part, which is the buy box. Now, when a real estate person is saying, "Hey, what you looking for? What's your ideal property?" We're really asking about three main things. First one's geography. Where is it? Which state? Which county? Which neighborhood even? It would all matter. Okay, so that geography is important. Second one, size. Now, in multifamily, you tend to use the number of apartment units as the indicator of size. And the reason why it's important to know what kind of unit count the real estate person you're speaking to is looking for is because the type of team that takes over 10 and 15 unit apartment complexes are going to be fundamentally different from the ones that take over 150, 350, and so on. So that size is going to matter. But the third one is usually called. I should probably also mention there are other types of commercial real estate that go off of acreage or square footage, but that size still applies. But the third one is usually called class. I prefer the term desirability because it's okay to have more than one factor in that, whereas class sounds like it's singular and I'm just being weird. But those two parts are condition and area. And if you're talking about condition, that's how old is the building, how beat up is the building, and recently renovated, that sort of thing. And then what sort of luxuries and amenities does it have that makes it more desirable or less desirable for the residents? So that's the condition. Whereas the area, we're talking about residential more often than not on this show. So the school districts where the property is located is going to be very important. But every type of real estate is going to depend for its value on the crime rate where the property is located. And then, of course, there's that old saying, location, location, location. I got a bit of a chip on my shoulder for that one because I think it should be traffic, traffic, traffic. If a gazillion people pass by a property every single day, you can be confident that it's going to be worth a lot more money than a place that receives less traffic. But both the area and the condition are ranked the same way as in grade school, where you got A plus at the top, and then A minus, and B plus, and so on. So, David, you already mentioned that 506c property out in Florida, if my recollection serves. But as far as your buy box, is that basically what you're looking for, or what's easier to say yes to?
Yeah. So, I mean, in this case, it took us about a whole year to find this deal, right? We actually had another deal in Tampa we put under contract, and it got stuck. It got stalled because the seller wanted a 1031 exchange into another deal. And as you know, the good multifamily units out in that area, Southeast, they're few and far between. So that one got stalled. We found this one. It's a desirable area. I would say that B class kind of range. but it's next to a lot of A-class area, short distance, but it's right there on the water. Beautiful
Hmm.
location, and we had two other buyers that almost bought it before us with the year prior, but they both fell through. So we actually got this deal. If you look at the numbers, about 30% under market value right now. They were a motivated seller, ready to get this off. It was the last deal on their plate that they needed to offload. So.
Hmm. Hmm. Beautiful, beautiful. So that's the buy box. So let's talk about people. And people are definitely my favorite part of this industry, and I'm not even blowing smoke. Maybe it's because I came from a tech background where people are traditionally antisocial, but the reason why real estate people are so friendly is because it's multifaceted. Everybody has different jobs, and we tend to be really eager to make new introductions, build new teams, just because the more people we know who are successful, the better off all of us will become. But at the same time, we have our own unique skill sets, so we're going to be better suited to help some people more than others, even though at the end of the day, everybody in this business is in the business of deploying capital. So everybody needs to speak to more financiers. But me personally, it's the sponsors and KPs that I'm usually talking to, especially as I get deeper into different lending organizations. But as far as marketing and online media and the different things I tend to do, I need somebody who has a foundation already created rather than somebody who just needs grunts who can work 90 to 120 hours a week, because that's not how I'm at my best. But David, as far as who's out there in the audience, who can you help the most?
Yeah, of course. So there's really two types of people that I help here. I mean, investors that want to get into a really good deal that like multifamily or RV parks. I come from a family that's been in real estate for 4 decades now, primarily in RV parks for the last 14 years. We're the largest operator of RV parks in the state of Colorado right now. Right. So, and then of course we have some great multifamily deals out in Florida. So anyone looking to invest into Florida or Colorado, I have a very good footprint in those different markets. Now, the other type of person I can help is someone that wants to get into business, someone that wants to start raising money. They want to learn, whether they're a beginner or they're very advanced. We work with both types, but people that want to get in the game of commercial real estate, they have a vision. They want to change their finances. They want to have more ownership, and they want to take control. So for those type of people that need to learn the skill and art of raising money and acquiring real estate, we can help those people out. And that's at raisingcapital.com.
All right, beautiful. And you covered one of the questions, which is how to reach out, because I'm sure that's top on people's minds. But of course, I'm just going to sandbag that for a second and talk about myself. So, if you use my name, which has this distinct last name, it makes it super easy to find me on LinkedIn, which is where I spend most of my social media time. Other than that, I also am an author. If you check out Amazon.com, type it up there, you can see I've got a few different books on different business skill building related topics. So you can check that out. But if you are going to be raising money and you want some help with the legal side of things, I have a service called 506 Beamy. If you pause the video and scan these codes here, that gives you the FAQs page of 506 Beamy, which is really to show you the different things that you need to have in place for the SEC if you're going to be raising capital, and if you want our help in the maintenance, collection, and all that, the backups of your list of substantive relations. That's what we offer. And the reason why you'd be interested in it is because if you drop your laptop into the bathtub, you might have a problem with your documentation not being around when the SEC audits you. So that's what I'm up to. David, what are the best ways to reach out? You already mentioned raisingcapital.com, but I don't know if social media, websites, phone, email, what are the best ways?
Yeah, best ways is going to be email or Instagram. If you're on Instagram, my Instagram handle is davidanderson.live. Again, that's davidanderson.live for Instagram. And if you'd like to hit me up on email, we'd love to meet you there too. You can email me at david@raisingcapital.com.
Pretty easy to remember, just like my public service announcement, which is how I always end these episodes. It's not for you, David, it's for you in the audience. If you've been watching this episode and experiencing searing pains in your eyeballs and like migraine like symptoms, I'm confident it's because you didn't hit the downright hideous subscribe button down there that you can just hit for free. And I want a lot of people to click on it, because if they do, then YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. The trade-off to you, just so we're clear, is my videos may show up on your list of suggestions. You can feel free to ignore those suggestions, because quite frankly, I just appreciate the fact you spent this time with me. Just like David, I appreciate you joining me. This has been fantastic.
Absolutely. Yeah, this is great. Thanks for the invite, Dan. Pleasure to be
Awesome.
here.
For sure. Thanks.